So let's go back to some of those accredited investors we were talking about before and get into some of the roles that they play. So first is an angel investor, right? And this is often a high net worth individual who invests in early stage companies, startups or early stage, in exchange mostly for an ownership stake, meaning they're much more likely to make some sort of an equity investment. It could be a convertible note or a safe as opposed to a debt investment. They may do debt as well, but frequently get involved in some sort of ownership. And they invested about $29.1 billion in 2021. So angels are a critical source of capital for early stage enterprises. It's not uncommon for them to be people that the entrepreneur knows, right? That may be part of their family or their alumni network or their social capital. And so this is where you see a lot of bias and who has social capital with people with wealth and who does not have access to folks with wealth to be that early money that's coming in. And angels are supposed to be angelic, and sometimes they aren't. They can be true allies and opening doors and providing knowledge capital. And sometimes they can create pressure and uninvited influence. That's why I added the devil piece. So you want to know who your angel investor is and be in right relationship with them. And then there are family offices. And so family offices are private wealth management firms that are established often by high net worth families. And there's a whole set of services in there. They're doing investment management, financial planning, estate and tax planning, charitable giving planning, and more. And a lot of family offices range from about, 50 million and below to 500 million and above. The median is about 150 million of assets under management. I just wanted to share who the three highest wealth family offices are. So we have Sam Walton, Bill Gates, and Jeff Bezos, right? So Walton Enterprises is $224.5 billion of AUM. Cascade Investments, which is Bill Gates's group, is $170 billion. Bezos Expeditions, $107.8 billion. So this is the vehicle that the uber wealthy are using to manage their wealth. And they're not making most of their investment decisions. Sometimes that's staffed at the family office itself, and often it's run by RIAs, registered investment advisors. So these are the financial advisory firms that manage client portfolios, and they do it as fiduciaries. And I'm going to return to that concept of fiduciary in a moment. They typically take a fee based on assets under management as opposed to taking a commission on trades or products sold, but it's all over the map. And on this slide, you will see that there's a whole breadth of what's considered an RIA, right? We have the wealth managers, hybrids, asset managers, hedge funds, and TAMPs, turnkey asset managers. I actually really want to focus on the wealth manager segment at the top of the slide, because these are the folks that advise clients on their investments and may manage their investment portfolios. There may be some other services such as estate planning. And these are the folks that are making decisions for family offices, high net worth individuals, and often foundations will hire an RIA. And so they are the gatekeepers. So when you're going out to pitch, especially if you are an impact investing fund and you're going out to pitch someone, you're often pitching an RIA. And here's the thing about fiduciary obligation. So this is the responsibility to make good decisions on behalf of your client with their wealth. And one of the problems is that white male asset managers control 98.7% of the investment industry's $69 trillion in assets under management. So let's take a look at the elements of fiduciary obligation. Duty of care, right? The responsibility to be informed that you are going out and getting the data and the information that you need to make a decision. Duty of loyalty, you're acting in the best interest of the beneficiary. Good faith, obviously, you're acting within the law. Confidentiality, clearly you're not going to take the information that you're getting and use it for your own gain. Prudence, here's where we start to get into some real challenges, right? You're making decisions with the highest degree of professional skill, caution, and critical awareness of risk. We've talked before about who's making decisions about what kind of risk. How do we understand risk? What does caution mean? So we're going to see all kinds of problems emerge with prudence because, for example, we might say something like, we don't invest in first-time fund managers. And if you're not investing in first-time fund managers, you're not including a lot of folks, especially emerging fund managers of color, who have not had an opportunity to steward assets before. The track record issue. We need to see somebody's track record in order to make an assessment of whether or not to put an investment there. If somebody doesn't have a track record, you can't make that assessment. So the duty of prudence is one of these challenges. It's meant with good intent, perhaps, but it's also why we're seeing 98.7% of asset managers be white and male. And then duty to disclose clearly is about disclosing information that would be relevant, for example, a conflict of interest. So again, the fiduciary obligations are made with good intent, but they are part of the structural obstacles to diversifying the finance industry and allowing impact to be the first metric, because a lot of people will interpret fiduciary only through a financial return lens and not an impact return lens. And so there, thankfully, is a movement to broaden our understanding of how to think about fiduciary responsibility. And this is called Due Diligence 2.0, and I'll provide a link to this so you can review it directly. And a lot of it is saying we have to actually look at an alternative to traditional due diligence. Due diligence is the process of making an assessment of should I make this investment or not. And so one of the things that they're looking at there is consider track record alternatives, right? If somebody doesn't have a track record, can we evaluate them based on past experience somewhere else, or their ability to source good investments, or their domain expertise instead of an investment track record? Assessing their ability to work together, meaning, again, that's a lot of this has to do with not being a first-time fund manager, right? Because if you're in your second or third or fourth fund, we already know the team can work well together. So can we assess work together based on the stability of the partnership or their work at other organizations or the time that they've spent building the firm? Assets under management is often used as a risk metric as a proxy for financial stability, meaning the larger the AUM are, the more stable this fund is, and therefore we should greenlight it, whereas a small one is less stable. So replace that with other metrics like a history of operating effectively, or their momentum for growth in AUM, or something that they've done again elsewhere. Respect BIPOC time. So emerging fund managers of color, that's what that's referring to. They get put through bigger and longer hoops than other fund managers. And so it's a declaration that we cannot demand more time and put higher bars for BIPOC fund managers than their white male fund manager equivalents. Contextualized fees. So sometimes it is the case that higher fees are correlated with lower assets under management, as well as the higher cost of working in disinvested communities. So sometimes when there are higher fees on emerging funds, there's a reason for that, and we need to place them in context. Including historically unrecognized risks means actually exploring the risk of not investing somewhere, the risk of social unrest or climate mitigation, or reduced government revenue from economic underperformance. So we need to expand our lens on risk, as we've talked about in other modules. Being willing to go first. So being first money in. Say yes. A lot of investors wait to see someone else take the lead. Due Diligence 2.0 is saying, let's invite people to be the first ones in and say yes. Offer transparency about the remaining hurdles. This is actually connected to respecting BIPOC time. Like, if there are going to be any deal breakers, if there are going to be some minimum thresholds for investment, let the fund manager choose to walk away, right? Give them more information about what the RIA is looking for, what they're doing their due diligence on. And then finally, provide detailed feedback. So if an advisor is going to reject a fund manager, then be very specific and honor them by sharing exactly what you would have needed to see be different so they can learn and grow. So, due diligence 2.0 is an example of an effort to rebalance power so that there is a relationship of mutuality between the capital seeker, in this case, a fund manager, and the capital provider, in this case, someone doing due diligence, a registered investment advisor, some other professional who's making an assessment of where to move capital. And the goal throughout all of these capital seeking relationships is this effort to rebalance power and bring forward some of the invisible biases that are built into the finance industry.